This market is doing something that frustrates almost everyone. The price action says one thing, but the data says something completely different. Whales are accumulating at one of the fastest rates we've seen. XRP investment products have now posted 8 straight weeks of inflows. Lawmakers continue moving toward clearer crypto regulation, and institutions keep expanding the infrastructure behind digital assets. So why does it still feel like nothing is happening? Today we're separating price from progress, because those two things don't always move together, and history suggests that's when investors need to pay the closest attention. Let's get into it. Everything discussed today is for educational and entertainment purposes only, and should never be considered financial advice. Always do your own research before making investment decisions. Welcome back to Ledger Pulse. If you've been following crypto for a while, you've probably noticed something interesting. The biggest stories in the industry don't always show up on the price chart first. Sometimes they appear in regulatory developments. Sometimes they show up in on-chain data. Sometimes they're hidden inside institutional partnerships that barely make the headlines. When you step back and connect those pieces, a much bigger picture starts to emerge. That's exactly what we're doing today. We'll look at why some veteran analysts believe Bitcoin is following a familiar path, why whale accumulation has accelerated dramatically, why XRP continues attracting institutional capital, and why the infrastructure being built today could matter far more than many people realize. Let's start with Bitcoin. One of the more interesting perspectives this week came from blockchain backer. He pointed out something many market participants tend to forget during periods of uncertainty. People often become obsessed with moving averages. Every correction brings countless posts claiming the latest moving average crossover confirms the beginning of a bear market. Historically, that simply hasn't been reliable. Blockchain backer notes that Bitcoin has repeatedly interacted with its 100-week moving average throughout previous cycles. Sometimes price holds it. Sometimes it briefly breaks below it. But the moving average itself has rarely been the signal that determines where the cycle ultimately ends. Instead, major bottoms tend to form only after fear reaches extremes. He also reminds everyone that what traders call the death cross has historically been a lagging indicator. It reflects what has already happened, not necessarily what's about to happen. That's an important distinction because markets are forward-looking. By the time technical indicators confirm weakness, much of that weakness has often already occurred. Another analyst, Decode, echoed a similar idea. He argued history doesn't suggest we're already at the exact bottom. Instead, history implies we're approaching the region where long-term investors typically begin paying close attention. Nobody knows the precise day a market bottoms, but history has shown that periods of maximum fear often become periods of maximum opportunity for patient investors. That doesn't guarantee history repeats. Markets never move exactly the same way twice, but understanding previous cycles helps remove emotion from decision-making. While retail sentiment remains cautious, on-chain data is telling another story. A chart circulating this week by Psychedelic showed one of the largest increases in whale accumulation ever recorded. Large wallets have been steadily increasing exposure while smaller investors remain hesitant. Why does this matter? Because whales generally aren't chasing headlines. They typically position themselves months before major narratives become obvious. That doesn't mean they're always right. Large investors make mistakes too. But throughout crypto history, major accumulation phases have frequently occurred during periods when public sentiment was extremely negative. Think back to previous market cycles. Near major tops, everyone wants in. Near major lows, almost nobody does. That's exactly what creates opportunity. Retail is asking whether crypto is finished. Whales appear to be asking how much they can accumulate. Again, this doesn't guarantee an immediate rally. Accumulation phases can last weeks or even months, but watching where larger participants deploy capital often provides valuable insight into long-term market confidence. Now let's shift to XRP. Despite broader weakness across portions of the crypto market, XRP spot ETFs have now recorded 8 consecutive weeks of positive inflows. That's especially noteworthy because other ETFs have experienced outflows during the same period. Think about what that means. Institutional investors aren't simply buying crypto. They're becoming increasingly selective. They're choosing specific assets. 8 straight weeks suggests this isn't random. Large investment firms generally don't allocate capital based on social media excitement. Their investment committees evaluate liquidity, regulation, market structure, and long-term utility before making decisions. That doesn't mean ETF inflows automatically translate into explosive price appreciation. Markets are far more complex than that, but sustained inflows indicate continuing institutional interest. When money consistently enters an investment product despite broader uncertainty, it's usually worth paying attention. One of the biggest long-term stories remains regulation. This week, we received additional optimism surrounding the Clarity Act. Representative French Hill expressed confidence that bipartisan support continues building. Meanwhile, Senator Cynthia Lummis once again stated she believes lawmakers are going to get the Clarity Act done. Notice something interesting. Whether legislation moves quickly or slowly, the direction has remained largely the same. For years, the industry asked for clearer rules. Now, lawmakers are actively debating exactly how those rules should look. That alone represents enormous progress compared to where crypto stood only a few years ago. Markets often focus on short-term price movements. Infrastructure focuses on decades. Clear regulation provides something institutions value enormously: certainty. The easier it becomes to understand the rules, the easier it becomes for larger financial firms to participate confidently. Another development deserves far more attention than it's receiving. Ripple's acquisition of Hidden Road continues revealing why this move could become so significant. Recent updates from the DTCC Government Securities Division show Hidden Road has approval for several critical institutional services, including netting, repo netting, and general collateral finance. These aren't flashy announcements. They're part of the financial plumbing that keeps enormous markets functioning efficiently. Netting reduces settlement obligations. Repo markets provide short-term funding for financial institutions. Collateral finance helps institutions manage liquidity across massive portfolios. These systems process extraordinary amounts of value every single day. When people hear the phrase financial infrastructure, this is exactly what they're talking about. It's one reason Ripple's acquisition generated so much discussion. Rather than building relationships from scratch, Ripple acquired an established institutional prime brokerage deeply connected to traditional financial markets. Whether XRP ultimately plays a major settlement role remains something the market will determine over time. But one thing is undeniable. Ripple continues positioning itself closer to institutional infrastructure than ever before. Speaking of Ripple, another encouraging development involves RLUSD. Payments platform Fonbank now lists RLUSD among its supported stablecoins alongside XRP ledger integration. What's particularly interesting is where the company operates. Its focus includes regions where mobile payments continue growing rapidly, including parts of Africa, Brazil, and the Philippines. Stablecoins have become one of crypto's fastest growing sectors because they solve a very practical problem. They allow users to move digital dollars quickly while avoiding much of the volatility associated with traditional cryptocurrencies. Every new integration expands the potential network. No single partnership changes everything overnight, but consistent expansion gradually builds a much larger ecosystem. That's often how adoption happens, not through one massive announcement, but through hundreds of smaller integrations that slowly connect into something much larger. Another headline that caught attention came from Japan. Reports suggest one national corporate pension fund is considering allocating a portion of assets toward cryptocurrencies. If additional institutional pension funds eventually follow, that represents another category of long-term capital entering the space. Pension funds typically invest with extremely long time horizons. Their objective isn't chasing short-term momentum. It's preserving and growing wealth over decades. Even relatively small percentage allocations from large pension funds can represent meaningful capital because of the size of the assets they manage. Whether this particular allocation expands remains to be seen, but it reflects a broader trend we've discussed many times. Traditional finance isn't moving away from digital assets. It's gradually moving towards them. When you zoom out, the individual headlines begin telling one larger story. Bitcoin continues trading in a way that resembles previous market cycles. Whales are accumulating aggressively, while sentiment remains cautious. Institutional money continues flowing into XRP ETFs. Regulatory clarity appears to be getting closer. Ripple keeps expanding its institutional footprint. RLUSD continues finding new real-world integrations, and some of the world's largest financial institutions are becoming increasingly comfortable with digital assets. Will that guarantee prices move higher tomorrow? Of course not. Markets don't work like that. There will almost certainly be more volatility ahead. But if history has taught us anything, It's that the market often builds its strongest foundation long before the next major move becomes obvious. That's why it's important to watch more than just the charts, because while price grabs the headlines, progress is often happening quietly in the background. If you enjoyed today's breakdown, make sure to like the video and subscribe so you don't miss future episodes covering Bitcoin, XRP, macro markets, regulation, and the institutional adoption transforming crypto behind the scenes. Now I'd like to hear from you. Do you think the recent whale accumulation is signaling the next major move? Or do you believe the market still needs more time before the next leg higher? Leave your thoughts in the comments below. As always, thank you for listening, and I'll catch you in the next one.